He is the Chief Research and Investment Officer. He joins us again for a good discussion about global politics and, well, we're even going to throw religion in there today too, Dan, just to really throw the kitchen sink at everyone. You're welcome to laugh at that to begin with. We are not going to talk about religion, but we are going to talk about global politics as it relates to investing. Just for everyone to understand what we're talking about, we're going to start with interest rates. We are going to talk a little bit about global politics, its influence on the investment markets in total, talk about pricing within markets, and then I would like to finish it up with a discussion of summer volatility, which was in my most recent video to clients, Dan, about preparation for volatility in both directions. So welcome back. Thanks so much again for joining us.
Lou, it is great to be with you. Thanks so much for asking me back. It's good fun.
Of course. Yeah. Well, you keep up the good work, Dan. We keep asking you back, okay? So so keep it up. All right. So let's jump to interest rates. We are just about to have a Federal Open Market Committee meeting this week, as a matter of fact, and they are going to discuss the possibility of raising, lowering. You had a good perspective on let's say politics creeping into the discussion of interest rates. So if you could tell us your thoughts on interest rates, where they are, what you see occurring with those at Morningstar.
Yeah, of course, Lou, absolutely. And I think it's a really interesting time for interest rates because, as we know, they used to be very separate from the political landscape. And we know that President Trump is very keen on lower interest rates. And so interest rate setting, interest rate policy, the Federal Reserve has become enmeshed in the political landscape. And so on the one hand, we need to take that into account when we're thinking about what could happen next. But when making forecasts about interest rates, there's a really interesting market that exists that allows people to essentially bet on what interest rates will be in the future. And if you look at those markets at the moment, then what it's saying is that there's a 99% probability that interest rates will not change on Wednesday. So I don't like making predictions, but I think that's a reasonably safe one. I think we can say that interest rates are very unlikely to change on Wednesday, despite the calls from President Trump. And this is a really interesting dynamic in markets. We know that comments from the president really caused markets to move earlier in the year. Some of those exec orders that he issued, some of those tariff policies. But we're seeing some of that seemingly wash out now. And a good example of that is that the president has called for a 1% cut in interest rates immediately. But the probability of that happening by the end of the year, according to these interest rate markets, is only about 3%. Now, if you were down the track, that's a pretty slow horse you're betting on. And so we can't really expect that to happen. So I think when we think about interest rates, the thing to remember about them at the moment is they're pretty normal. So whether you look at immediate interest rates or longer-term interest rates expressed through bonds issued by the Treasury, then interest rates are pretty normal. And that's a good thing for most people. It means that you can get a bit of a return on your cash on deposit in the bank or on the bonds that you buy, which really wasn't available to you for the last decade when interest rates were below the level of inflation.
Right, and mortgage rates were so nice; they really were. They were so attractive. Yes. But the flip side of that was you were earning 0.001 in your savings account. So now there's been a bit of a trade-off there. And I have spoken with some people, young people who are buying homes, people who are buying second homes. They're, let's say, shocked by interest rates. And we've had this discussion in the past, but it's always good to bring it up again. They're normal. They're a 6% mortgage, a 7% mortgage is perfectly normal. And someday we'll get to refinance those. But then we'll be paying, I think, a different type of price, which is economic slowdown is likely, and that's where interest rates. So I do have a question on interest rates and the Federal Reserve or the committee lowering them. They really use that as one of their tools, Dan, don't they, for fiscal stimulus? So if there isn't evidence that we need that stimulus within the economy, they're not likely to lower them, correct? Do I
That's
have that right for
exactly
everybody?
right. Yeah, that's exactly right. And so if we go back to the first lessons that we learned in economics, it's that if you want to stimulate the economy, there's two things that you can do. One is that you can cut taxes and increase spending, and the other is that you can reduce interest rates. And so at a point where people are talking a lot about the bill that's going through Congress at the moment, which may lower some taxes, may increase some spending, then that's very unlikely that the Fed is also going to act at the same time until there's clarity there, even if the economy slows down a little bit. And so even with an economy that may slow down, people do expect a couple of interest rate cuts over the course of this year, but in reality, the Fed is unlikely to pull that lever, while Congress is also thinking of pulling the same lever, because that could overstimulate the economy and get us into all sorts of trouble.
Yes, sir. That's okay. And then we get into inflation, hyperinflation, and we do have global politics to jump to now, which of course there's conflict all over the world. The U.S. stock market really being, let's say, the driver of stock markets throughout the world. And I know there are other stock markets that are very big and they have great volume and everything else. But we talk about the U.S. stock market here. So global politics, their impact on the U.S. stock market, and the impact on thinking of where are we investing our money? Are we pulling away from the foreign investment, looking to get it back to the U.S., or do we continue with that perspective that we should be looking outside the U.S. because we've had this 15-year run up of the U.S. stock market? Thoughts on that, Dan?
Yeah, of course. So the first thing is, when we talk about geopolitics, then we're used to talking about tariffs and trade tensions and things like that over the last few months. But of course, what's happening right now is this conflict that's ignited in the Middle East between Israel and Iran, and so we're seeing a lot of fallout from that in terms of concerns about a broader conflict. We've obviously got wars going on in Ukraine and elsewhere in the world as well. So geopolitics has become very real. It's affecting people's lives directly. And of course, that causes a certain panic for some people when they think about what the future may hold. And that's normal that people feel slightly panicked, because when you're faced with all this bad news, then naturally you want to take some action. You want to protect yourselves. It's easy to imagine that this becomes a much bigger issue. But I was looking at my notes a little bit earlier from the first time we did a video together, which was towards the end of 2022. And at that point, we were talking about geopolitics.
We're always going to be talking about them.
Exactly. And it's just worth remembering that since that point, the US market is actually up 60% since that point. So if you'd got concerned about geopolitics in 2022, then you'd have missed out on huge gains. And so we know that geopolitics is personally troubling for many people. We see our friends and relations impacted by it. But let's remember, it is separate most of the time from investment. Geopolitics is pretty unpredictable. Very few of us are experts in forecasting what's going to happen next, but we know that over the long term, a good invested portfolio is likely to deliver decent returns. And so as far as people can, I say try and put aside geopolitics from your investment planning, from your retirement planning, from building portfolios, from thinking about the impact, because it's entirely unpredictable. Instead, remember that what really drives returns in your portfolio, what drives your ability to retire the way that you want to, is likely to be long-term economic growth and the price that you pay for these investments. So if you're buying investments that everyone's really enthusiastic about, you're likely to get a slightly lower return. If you're buying investments that other people hate, you're likely to get a slightly higher return because you're getting them more cheaply. And so as we look at it through that lens, then what we see is that, as you say, the US has been on an incredible tear over about 15 years. And now prices look a little bit high, not very, very high, but a little bit high. And they look a little bit high compared to the rest of the world. And that's true whether you look at just the stocks themselves, or you look at the US dollar, which is, of course, how we price stocks, whether it's in the US or elsewhere in the world. And so as we look at the world at the moment, we see a few more opportunities outside the US. Now, that's not the same as saying that the US as the foundation of global capitalism is coming to an end. There's very little evidence for that view. There's some amazing companies in the US, as we know, but you get slightly better value if you're investing outside the US at the moment. And so it's worth thinking about that, thinking about having that diversification, thinking about having some investments in markets in other countries as well as the US, because you're likely to get a slightly higher return over the next 5 to 10 years. It may not do anything for you over the next sort of 3 to 6 months. That's not how investments work. But in general, you're likely to get a slightly higher return. And that really is independent from whatever's happening on the geopolitical front.
Sure. And thank you for bringing up 2022 when we started these conversations. And thanks for starting them with me, Dan. I was actually just explaining to our summer intern, Connor, how we started these conversations, where I went all Jersey on the person I was working with at Morningstar and said, if they're investing in China, somebody better get on the phone with me right away. And there you were. That was awfully nice of you. And now here we sit having this good discussion again. And as it applies to that volatility and the looking for value, that's where, and it's not only Morningstar, but it's all the different firms that Tranquilli Financial Advisor chooses to work with on behalf of clients. I think it's really important right there to point out that we are diversifying not only what we own, but the theory of how we own it. And yes. I'll say I'm proud of that. I'm proud that you and I have had conversations about that, and it may have been maybe a different perspective that you hadn't experienced in the past with a financial advisor. So I'm going to continue to do that in the way of management for clients, because at times Morningstar is most correct, and at other times one of the other firms is most correct. But the idea is that we're taking good care of client dollars, and that retirement planning and personal planning for those who aren't close to retirement. And geopolitics, this volatility comes in, and I want to get to that in a little while. But you had mentioned while we were talking before we started recording that things are normally priced. Could you go over that, please, as it applies to the U.S., as it applies to outside the U.S.?
Yes, absolutely, Lou. The markets are priced in a freakishly normal way at the moment. So we
That's a great way to put it, Dan. That's freakishly normal.
So if we think about the very long-term history of markets, then prices at the moment are pretty average. Whether you look at most U.S. equities, some are priced a little bit more expensively, some a little bit more cheaply. You look at bonds, you look at overseas equities as well, and so that really is a great opportunity for looking at the world and deciding how much risk you want to take, where you want your money invested, which assets are going to provide the best returns over the long term, because you're not trying to make decisions under periods of extreme pricing. We know sometimes when prices get very, very high or very, very low, it's very difficult to decide to sell or buy an asset because you're dealing with prices that have a lot of momentum behind them. Either they're going up very quickly or they're going down very quickly. And that's a difficult situation to make decisions. But at the moment, most asset prices are near normal. So if you dig a little bit deeper in US markets, we think you can find more value in smaller companies. You can find better pricing in companies in traditional industries. If you look outside the US, I said earlier, we think you can find some better prices there. But we're not at these extreme points where investment decision-making is difficult. And that's a really good time to be an investor, because you can make these decisions in a much calmer way than you've been able to at more extreme points in history.
That's great. Thank you. And I'm going to throw this at you because, and we didn't talk about it before hitting the record button, the AI trade and digital currency. Update us on where Morningstar stands on digital currency, please.
Yeah, sure. So I would definitely separate AI and digital currencies. So
Yes,
digital
I agree.
currencies, we don't see any value in traditional cryptocurrencies. Now, for aficionados listening to this, you may want to challenge.
They are out there.
Exactly. You may want to challenge my view on stable coins, but let's leave those aside for a moment and just look at the traditional cryptocurrencies or the meme coins or whatever it is that people are selling right now. And so when we look at that type of asset, then it fails the two tests that we look for in determining whether something is an investment asset. The first thing that an asset has to have to be investable is to deliver a cash flow, i.e., by owning this asset, it should provide you with a benefit to owning it, a cash flow to owning that asset, and you should be able to have an idea of what that cash may be when you come to sell it in the future. So cryptos do not deliver you a cash flow. They are an asset that stays the same at the same value. There's no cash flow coming out of it. Now you can lend it to deliver cash flow and things, but we're just talking about a normal holder of cryptocurrency. You're not getting any cash flow. So it fails the first test. The second test is that something has scarcity value. So if we think about gold, there's a limited amount of gold on the planet. Once it's all been dug up, that's it. There's no more gold. And so if we all agree that gold is worth something, then that scarcity value gives it a value long into the future. And you could own that if you wanted to. We don't think gold is a great investment, but you could own that, and that has genuine scarcity value. Now, a lot of the talk around cryptocurrencies is focused on an individual currency, which people would claim has scarcity value, that no more can be created. Now, I don't know whether no more can be created. I haven't looked at the algorithm, and I'm guessing most people haven't either. And if they did look at it like me, they wouldn't know what it means. And so you are trusting someone that any cryptocurrency you own has scarcity value, and that's a high level of trust. If that's a portion of your savings that you're trusting to someone who owns an algorithm, but okay, let's say that's true of a particular coin, but there's an almost infinite number of coins out there now. And so when we look at the entire crypto universe, then the only value that is logical for the entire universe is zero. And so you can have variations around zero because zero is not perfectly accurate, but nevertheless, the entire crypto universe has to be worth roughly zero because there's no cash flow and there's no scarcity value. And so that chills me to the bones when I see people who are investing a large portion of their wealth in cryptocurrencies. And certainly, is not something that we would recommend. There are, of course, other viewpoints, but that's the one that we've held for many years now. AI is obviously.
Hang on before you get to AI.
Oh yes, of course, yes.
I just want to throw this in for everyone listening that when we talk advisor to client, ask me for my extreme take on digital currency, okay? And then I'll share it there, all right? It's an extreme take of what you just said, Dan, all right? So we'll get back to that. So I apologize, but carry on with AI, please. A far more reasonable conversation, I'll say, than digital currency.
Well, that is just a great reason for people to have a conversation with you, just to hear that view. I've heard that view, and it's definitely worth talking to you about it. Okay, that's what you want to weigh out.
I'll give it to you after we're done recording.
Yeah, exactly. So from an AI perspective, that's really different because this is likely to be world-changing technology, and when you see a technology that could change society, could change the world, could change economics, then naturally people want to invest capital alongside that theme. And you may well do very well out of investing in AI. But remember, there's been lots of episodes of world-changing technology in the past that haven't favored the investor. And so if we go back far enough, we get to the railways. So the railways did change the world. But you will know if you've ever been into a second-hand coin shop or a coin trader, there's plenty of share and debt certificates for railways that went bust all over the world, which you can pick up for pennies. So a lot of the shareholdings in railways became valueless because people invested too much. The same was true before the dot-com boom. The internet did change the world. That doesn't mean that people who invest in pets.com made any money.
Great example, yes.
This is true of every big innovation through history, that simply because something changes the world doesn't mean that it delivers good returns for all investors. So just be very careful that the rules for investing are the same, whether you're investing in AI companies or anything else. You're looking for good value. You're looking for an expectation of a reasonable return, not just a bandwagon to jump on.
Excellent. Well, I'm not a bandwagoneer, so well done, and thank you so much for that. We had not prepared for that. All right, let's finish with summer volatility. Volatility, it gets a bad rap, we'll say. All right, from the standpoint of you think volatility, you think drop, and that's. I think that's maybe human nature, but just reasonable to associate with the stock market as well. Volatility means a drop. Volatility can mean spikes upward, though, and we do like those. What could drive the U.S. stock market, let's say, out of a range into a volatility upward or a volatility a spike downward? What are those two? What are those two outlooks to get to either side of that?
Yeah, sure. So the first thing to remember about the markets is that in the summertime, a lot of people go on vacation, and that's an obvious thing to say.
Sell in May and go away. Yeah, right.
Exactly right. So this is a very old saying. This shows you how far this goes back. Sell in May, go away, don't come back to St. Leger's Day. St. Leger is a horse race in the UK. So this goes back a very long time. And the idea is that when you have fewer people engaged in markets, then there's lower liquidity, and so prices can run away in either direction. So if you remember last summer, early August, that prime time, we had that big fall in markets. It recovered very quickly, but you have these spikes of volatility, and again, as you mentioned, we can have upward spikes as well. So the first thing that's going to drive these spikes is going to be just that lack of liquidity that happens during the summertime. And so if you're sat reading your newspaper in the summer and you see that there's been a great rise or a great fall in markets, then just try to ignore that, because that's really just normal summer trading, and it's almost impossible to protect yourself against or to take advantage of. And so you're likely to have more volatile prices. What we want to be careful of is where that volatility is a harbinger of a more structural change in markets, which I think what you were alluding to there, Lou, and that's where we need to be careful when that volatility has been triggered by a significant change. Now, there aren't very many announcements in the summer, which is one of the reasons you don't get these very significant changes. But you could potentially have the genuine imposition of tariffs, which we know were delayed. That would likely cause some volatility. But as we mentioned earlier, people seem to be less focused on the president's latest pronouncements. You could see a more positive structural change, but again, that's less likely to come all at once. So in reality, I would abide by that old English saying that it's don't sell in May, but do go away. Don't focus on it too much, because in reality, the summer does tend to be a more volatile time. And when people come back from holiday, prices tend to return to normal. And as I say, at the moment, prices are freakishly normal. So we're in a good place just to let your investments do their thing over the summer, to look for pockets of value. That's what our team are doing, trying to improve the return on portfolios for the level of risk. Every investor is trying to do that, but nevertheless, this is not a time to make big decisions over the summer, particularly if you see prices moving.
Well, Dan, I am going to leave it there. I'll say that I'm left speechless, which is a rarity. Okay, well done. So thank you, Dan Kemp, Chief Research and Investment Officer, Morningstar Investments. Always appreciate your input, your perspective from the other side of the Atlantic is appreciated by clients. I can tell you they get back to me and thank me for these all the time. Hopefully they'll do so again, and of course we'll do this again. You won't sell and go away, but you'll go away for a little while, and when you're back, we'll do it again.
That sounds perfect. Well, let's do that. Thanks, Lou.
Well, all right. So I won't finish it on investments, but I know you're a dad. So it was Father's Day yesterday here in the States. So a very happy Father's Day to you. And I've said to all of mine yesterday, all four of them, every day is Father's Day. I take no days off. I ask for no days off. And they always prove it by asking me for something almost every day. So it's all good, you know.
And happy Father's Day to you as well. Yes. What a
Much appreciated.
wonderful day.
Right. We'll do it again soon.